Hello. Mic check. Hello. Hello. If someone could check the YouTube, make sure it sounds alright, I appreciate it. I haven't been on this computer in a little while. Alright, good afternoon. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial conditions. Position report. I got out of SanDisk and WDC. You know, the STX earnings combined with that Korean company was just was too much, and they move as a secondary to that. So those names broke out, and I got stopped out. So out of those names as well, have not added anything new. You know, just this. We got this crazy market extension, so I'm still short the indexes here off the crazy market extension. But, you know, we got Meta, we got Microsoft, we got Google, all out here after hours. Meta and Microsoft are down. Google is up. Is NVIDIA moving at all? NVIDIA is not moving at all. So the CapEx numbers are coming out above expectations. Oh, there's a whole lot to unpack for today. So let's try to do it. SPYs at this point are down small. I think we closed like very flat actually on the day for the SPYs. I'm not sure what percentage, but we're down a little bit after hours. The Qs are still up. They're up 0.2% now, but they're $1.50 off their highs. Still above the intraday low though. And the IWM, the Russell got hit again. The Russell got hit post-Fed. The Russell was actually trying to show some strength pre-Fed. Post-Fed, the TLT got hit, and it brought down the Russell a little bit. So I guess let's try to do one thing at a time here. So daily chart of this market, we are very, very extended. Today is like a day 4 to the upside after this breakout with some pretty extreme upside extension. Short-term tactical in the red like 3 days in a row. Most likely it's going to be there again tomorrow based on today's close. But you know, this, when you start to get into like the day 3, day 4, that's when the higher probability of the counter trend trade really begins to come in my opinion. Because you know, we've just seen it over and over and over again. It's very rare, but not impossible. Very, very rare. There's only been like a couple times ever that I can remember like short-term tactical being able to stay in the red for more than 3 days at a time, or in the green, right, on either of the extremes. And it's similar but different when I'm viewing my, you know, standard measure of market extreme extension of $10 plus off the ADMA and the SPYs and the Qs. It's pretty rare that they're able to do that for more than 3 days straight without giving some degree of corrective price action. But what that means is, you know, the first day you're getting to extreme extension, or the first day you're in short-term tactical red, it's not just necessarily a close your eyes counter trend signal. Because when there's really strong momentum, when the market's breaking out like it did last Friday, it was a major breakout, that momentum can really continue the market even within extreme territory for sometimes several days in a row. But that's the backdrop as we're kind of coming into today's trading session with so much going on. The Fed, 3 Mag 7 stocks reporting earnings, 2 more reporting tomorrow. Trump and Xi are set to speak tonight. And then I think that there's still a big overhang of the government shutdown actually as we get into this weekend, but that's separate. So what we've kind of seen as a result here the last couple of days is a little bit of like the spot up, vol up dynamic, but some of that is probably just related to the big movement in the market, but also the hedging that's probably coming in on new long positions that funds have, as well as all of the event risk. So that's the backdrop on today's trading session, and yet, despite that extension, we were able to stay extremely, extremely strong. Now, the day of a Fed day prior to 2 o'clock tends to be rather slow and boring. So it's not surprising that today was slow and boring prior to 2 o'clock and that the market traded in a pretty tight range. Not really surprising at all to see that. It's fairly normal, but given the fact that we were so massively extended, I thought maybe we could get a little bit more movement today. That obviously didn't happen. 2 o'clock comes around, 25 basis point cut, exactly as expected. I thought that maybe there was a little bit of a signal of a small amount of hawkishness with the Fed quantitative tightening ending on December 1st. My understanding is that they could have ended that pretty much right away here at the end of October, and they're giving us an extra month for some reason. But I was really kind of grasping at straws on that. So we saw like a tiny bit of weakness in the market, more in the IWM, which makes sense because this is the most interest rate sensitive sector. So the IWM was weakest as the TLT got hit down, and they're also attributing that to the fact that there was the one dissenter, I forget his name, who doesn't want any cuts yet. So we saw the one dissenter who is like the Trump appointee, basically, who wants the 50 basis point cut, and we have another dissenter who doesn't think it's appropriate to have any cuts. Everybody else felt that it was appropriate to have one. But that, again, small degree of hawkishness there was able to hit the TLT down and therefore cause weakness in the IWM. Now, a lot of times when we see Russell-related weakness as a result of the potential of higher interest rates or higher for longer or whatever, you actually then see strength in the NASDAQ because the NASDAQ doesn't really care about that, right? These companies, these Mag 7 companies, they've got so much cash on hand that I would argue that not only does higher interest rates not hurt them, it potentially even helps them because they're earning a return on a massive amount of cash that they actually have. So, we saw the Qs hold up really well, and then when Powell began to speak, he kind of dropped a bomb when he said that a December cut's not guaranteed. And that hit everything down. Obviously, it hit the IWM down the most for the exact same reason that I just discussed. Higher rates tends to most negatively impact the Russell, but it hit everything down, including the Qs, even though the Q move was the most muted. And then in the most remarkable fashion ever, we in the NASDAQ were able to fully negate that down move that happened off that comment, which happened at 235. Whereas right at the close, we were able to get back above that 235 high. And again, whenever you got those big Maribozu candlesticks on, that are broadly news-based, you always want to pay attention to the other side to see if it can get negated or not. The IWM, again, most interest rate sensitive, never even got close to negating its 2:35 p.m. high. It gave a great bounce back into the ADMA, gave a beautiful shooting star here. If you're focused on shorting relative weakness, you got follow through to new lows. That happened as the Qs, again, fully retraced that down move. And then the SPYs here, which are obviously also fairly market cap heavy, ended up being stronger as well. So pretty incredible as far as I'm concerned. I would expect, like Josh was saying and a couple people were saying, in any normal trading environment, you get a marginally hawkish Fed there, and that was hawkish. Like the main things that I was looking for on this was is any sign of hawkishness beyond expectations from the Fed meeting today, and I think we got it. And the fact that we couldn't correct any of this upside extension into a day 4, when you actually got hawkish language from the Fed, is like just pretty mind-blowing to me, honestly. But there's still a large market structure dynamic here where we keep getting very, very heavily insulated on an intraday basis, and market just keeps holding in and keeps going up. Now, to add insult to injury, after hours here, let's see where Microsoft is now. Yeah, we got two out of the 3 Mag 7 stocks trading lower. I actually think that the Microsoft report, from what I'm seeing on it peripherally, is not bad. I just don't think it's knock your socks off, and again, that tends to be what these companies need. The Google is a pretty darn good report, and they also have the lowest PE out of the cheapest company still by far out of any of the Mag 7s. So Google's up, Microsoft is down. I kind of agree with Josh's thought process here that at least initially, to some degree, Microsoft and Google are probably offsetting each other a little bit, though Google's up more than Microsoft is down. But then the third one here is the Meta report, and I think that the Meta report looks bad. I don't like those Meta numbers at all, and the stock is getting walloped on it. Meta is down 8% at this point. So after hours here, we're still not even seeing much of a pullback, honestly, when I look at the NASDAQ, despite what Meta and Microsoft are doing. And then the only other thought that I really wanted to bring up and mention, because I think it's important, is once again, we saw Oracle trade very, very poorly today. There was a Goldman Sachs research note from like a week or so ago that said that Oracle is really the name to watch in the AI space. If the AI trade is going to crack, it's probably going to be Oracle that leads the way, because this is the one that's being ultra aggressive insofar as their spend, their CapEx spend. Obviously, all these companies are spending insane amounts of money, but the difference is Meta is an insane cash generator. Microsoft is an insane cash generator. Oracle is obviously a good company, but they don't generate cash in the same way that those other ones do. So in order for Oracle to attempt to compete in the AI race, they're going free cash flow negative. And I guess we saw some action in the swap market today that led investors to believe that maybe there's something going on here where they're not liking the degree of CapEx spend from Oracle at this point, the fact that they're, going to start losing money basically as a company in order to try to be able to catch up. So I think that that's very notable in conjunction with the fact that we just saw Meta and I think Microsoft, and I'm not sure what the Google number was, but I'm pretty sure Meta and Microsoft just announced CapEx numbers that were above expectations. So one of the things that we've been saying for probably a year now is not as a timing thing or something, but just something to pay attention to, is will there ever come a point where the market just says to the CapEx spenders, obviously this benefits the NVIDIAs of the world, but to the CapEx spenders, hey, we've had enough of you spending like there's no tomorrow. And the closest, I don't know what the word is I'm looking for, the most similar situation from history that I can really come up with is Meta on its spending on the metaverse, which, if anyone remembers, that was a big deal back in 2022. The market hated it because the market didn't believe in the metaverse. That was the biggest thing. The biggest difference between the spending that Meta did on the metaverse versus the spending that these companies are doing now on AI is that the market believes in AI and the market never believed in Meta. But what happens if for some reason the market decides it doesn't believe in AI in the same way anymore? And that just goes back to something I've discussed in other afternoon meetings in the past about how, there's a chance. It's not about whether or not AI is going to change the world. It already is changing the world. It's about, is AI going to be able to change the world at a rate of the CapEx expenditure that's actually happening? My argument there is no. It's definitely going to change the world, but not to the degree to which the CapEx expenditure justifies. But the market has disagreed with my thought process, and the market is all that actually matters. The market's been rewarding these companies as they spend more and more money. But, when you think about that Goldman Sachs note and then you think about how Oracle traded, I can't help but wonder if that Oracle is a canary in the coal mine now that we're seeing a not as good report here for Meta, yet even increased CapEx, yet at the same time, NVIDIA is not really trading higher after hours at all. And I honestly think that, I mentioned this yesterday when NVIDIA was running, because they kind of pre-announced the next, I don't remember how many quarters of earnings. So it's probably fully expected by now and fully priced into the stock of NVIDIA. But I'll be honest, the price action is what pays. There's extreme upside extension here, but beyond that, this market is really, really bullish. Everything that I'm looking at is turning me more mentally bearish, but the technicals still need to confirm it. I don't like what I'm seeing from Oracle. I don't like what I'm seeing from this Meta report. I don't like the increase in CapEx. I don't think that they're going to be rewarded for it to the degree in which they're spending in the long run. I think that NVIDIA is fully priced in at this point on the even higher CapEx that they announced yesterday. And if you can start to see some cracks in the story of the AI spend, then there is no stock market without AI, because the rest of the economy is obviously not doing well, which is why these interest rate cuts are having to happen to begin with. But that's just my personal thought process. The technicals and the price action are what pays. Risk management's the key to success in the business. And, I like the idea of looking for the cuter extension shorts here, especially with what we're seeing happening after the close. There's another wild card tonight with President Trump and President Xi. So who really knows where the futures are going to open up? We got Apple tomorrow and Amazon tomorrow. There's another wild card there. But if we get through President Xi and Donald Trump and there's no major announcement that rips the market higher from that, and or there's an announcement but it gets sold, and we get through Apple and Amazon, I just don't see how, what's left to bring us up. As I say that, it's seasonality, it's the corporate buyback, but the corporate buyback is as strong as it can be in November, and why November is green every single year. It's just another flow that can actually be overwhelmed. So I don't know. We'll see what happens with the two earnings tomorrow. We'll see how this market's able to open. The bid underneath this market is like nothing I've ever seen over the course of my career. I was half joking in the VTF at a certain point today that the options market has broken the stock market, and it really was only a half joke. But at the same time, it's not impossible for that to make things even more violent if a break ever were to occur. We still have just never had a break actually occur. So the technicals here are still bullish but extended, and let price be your guide, I guess, is the bottom line. So that's all I got. All I got. I'm happy to answer any questions that anybody might have. Don't really have anything else that I need to review or feel like reviewing on my end. I could search for stuff, but rather would not do it. UAMI versus Quad U. So they're a little bit different companies. Quad U is a little bit more focused on uranium as far as I'm concerned, and UAMI is a little bit more rare earth. They're both, in my opinion, insanely overvalued at their peaks there. I'm all out of my UAMI short. I was short both, but UAMI worked really well, and the Quad U has not worked as well. The one thing that's making me very, very nervous about being short this Quad U, especially with what's happening tonight, has been the very, very consistent bullish option flow that we've been seeing coming into that stock. A lot of it's been fairly short dated, ending this week. So it kind of seems like somebody was making a bet on something happening with this Quad U related to Trump and Xi talking. So let's see how this thing trades tomorrow. From a technical perspective, I like it short. From a fundamental perspective, I love it short. But, I've really learned over the course of my career not to fight large institutional option flow. And I'm not a tinfoil hat guy. I'm really not a conspiracy theorist. But when you see that type of flow, we somehow, some way, very, very often see news events happen after, which would potentially indicate insider trading occurs in those situations. So that, you get the double effect almost when you have a company like this that's seeing a ton of bullish option flow. One is quite simply the gamma squeezes that can come from it, but two is, you don't know if you've ever seen me wear a hat. It's funny because I wear hats all the time, just not in work situations. So Quad U, one is the gamma squeezes that comes from the flow. Two is those happy coincidences that seem to happen to short-term options buyers in certain situations happen too often. So Bottom line is, I don't like either of them. I think that they're both shorts, even still, even with where that UAMI is now. I wouldn't chase it, but we'll see what happens. I think you could just be short this quad U versus 23, but just be careful about an announcement happening while the market's closed, especially tonight. So, appreciate you asking. From Uvixi Bull, if you took a look at the SPY from April 13th, 2022 onward, and then made an assumption, all right, 2022, that was in the throes of our bear market. It now seems so far away. April 2022, it's kind of when we were first legging down. No, it's actually when it was not in the throes of the bear market. It's when we were first kind of entering the tightening cycle bear market that we went into. April 13th onward. And then you make an assumption that that point forward is how the market will trade due to it being the day that 0DT options became a thing. It's the day that they became a thing. What conclusions would you make about market's movement and how we can trade it going forward? Also, is this an impossible task since this coincided with the rip from the depths of the bear market to where we are now? So I think that even more important than that is the increase in the use of those options between April 2022 and where we are now. The increase in the use of those has gone through the roof. I don't have the metrics to be able to quote you, but through the roof. So the market-wide impact that 0DTE, 1DT options were having back in April compared to the market-wide impact that they're having now, I think is vastly different. It's much, much, much larger now than it was then. And it really seems like more than ever that the movement of the stock market is 100% dominated by what is going on in the options market. Now, there's edge, I do think, to be garnered there. Bill K and the VTF, I think, is the VIP of that. So he's the one that I would be, looking to learn from and looking to learn how to digest the information that he provides. Because, if you understand the very base case that option trading activity has market impact, and then you can model out the wheres and the hows of that market impact, then that does enable you to derive some degree of edge. And I think that Bill has done a fantastic job here for himself and for the team, being able to provide that information to help develop that edge. So, that's what I would suggest to you on that. Cool. What else? Over into the YouTube. What is the probability of a trend day tomorrow? Great question. I think it's decent. The day after a Fed day has a higher probability of being a trend day than an average day. So I think that based on the multiple events that are occurring today, between what I thought was a hawkish Fed, but the market couldn't move, I almost wouldn't be surprised. Like, the market can't move because of market structure. But it can move overnight because you don't have those same 0DTE hedging flows ongoing while the market's closed. Yeah, and Bill, if that's the chart that I think it is, yeah, the levered, yep, yes it is. It's not impossible for us to just get a huge gap down overnight because the market decided it didn't like the Fed either. And if you get a very large gap, it probably lowers the probability of it being a trend day. But otherwise, we can assess this further in the morning. I think there's a higher probability than normal of tomorrow being a trend day. And then yeah, Bill here letting us know, showing us this chart. This chart of the levered ETF AUM growth is mind-boggling, but especially mind-boggling when you look at this latest peak that has just come in right now. You are getting a rebalance into the market of $7 billion per 1% move. I got news for you guys. The market's only been going up. So every 1% that we move higher is met with an additional $7 billion of buying approximately, from the levered ETF community. And I encourage you to think about that number in terms of like that 50,000 number that makes the market move. So you just have this impossible situation here of this virtuous feedback cycle of options making it difficult for the market to move a lot of times intraday, but there being a big enough of an underlying bid to this market between the ETF leverage rebalance and corporate buybacks and other flows that we're able to basically be up every day. And I think that that is a lot of why, when you look at the period between July 3rd to a few days ago, we are up like every single day, but the first time we hit any extreme upside extension in this market was just a couple days ago, going back to July 3rd. And I think that that's how do you get a market that's able to go up basically every day but never hit extreme upside extension? Well, you have market impact occurring from the options market that mutes the movement at the index level, but a ton of dispersion that is ongoing underneath the surface on the individual stocks as a result to kind of make up for it. And yet you get a consistent bid that's coming from, this feedback cycle of, we're going higher because of levered ETFs, and levered ETFs are making us go higher. Like, if that makes any sense, right? Like, the more we go up, the more they have to buy, therefore the more we go up, therefore the more they have to buy, therefore the more they have to go up. And, things like the corporate buyback bid as well. And that just enables us to be up that, 0.5% every single day that it seems like we were up between July 3rd and a couple of days ago before we actually started to accelerate. At a certain point, if there's ever a reason for it, an unwind could be massive if it were to occur. We got and you see how fast when they do occur, like you guys saw just back on October 10th, how fast it can occur if there's enough to be able to overwhelm some of those market stabilizing flows. But even with that, I honestly think that in terms of what could happen, October 10th is actually just like not even that big. Because I don't think that you didn't trigger truly the CTA trend following selling. You didn't, you got a bit of a VIX squeeze, but it wasn't like a VIX squeeze to 65 like we saw in August of 24. And you never really, I think, got enough out of the ETF leveraged rebalance on the sell side, and retail was able to absorb so much of it. So, I do think that there is the potential of a market structure situation. It's just one of those things that's impossible to time, where especially if you had an event occur overnight that caused the market to gap down 4 or 5%, it's not impossible, guys. It would probably just create so much destruction upon actual market open of the flow effect after the fact that it could make October 10th's down day seem like nothing. You could have an event that's, I think, purely market structure where you're triggering circuit breakers to the downside in the market. I think it's becoming more realistic of a probability as we just have more, this is a very generic statement that I'm about to make, so it doesn't necessarily apply. This is not necessarily apples to apples. But what created the financial crisis is financial engineering. What is going on with the options market and the options selling ETFs and the levered ETFs? That's all. It's all like. It's all us just, I don't know, creating this situation that could be that ultimate black swan event that people don't necessarily see coming unless they're heavy into the space and really understand market structure and understand that there is a potential there. But it's also one of those things. It's like, I'm throwing that out there as a statement. That could happen in 2025. That could happen in 2029. Your guess is as good as mine on where this gets to before there's an implosion, or if there ever even is an implosion. So but it's certainly it's certainly notable. This is the ultimate market structure in combo with AI spend and exuberance environment here that is creating a stock market that is not overly reflective of the economy, but is actually, in my opinion, making the economy much better than it would be otherwise. Whew, all right, well, that was a mouthful. So I'll wrap it up there. Have a great night, everybody. I will see you all tomorrow.